Hello, here we are again. We're going to go over Chapter 4, which is going to be the fundamentals of cost accounting or cost analysis for decision making. We're going to continue our conversation on how we use information to make decisions and the different types of analysis that we do to make some pricing decisions, whether or not to break even, whether or not a margin of safety. We're going to use differential analysis to analyze decisions. We're going to apply that analysis to pricing. We're going to also talk about different approaches used to establish price and how to apply differential analysis to production decisions, and also talk about the theory of constraints. Well, we want to talk about what we should do, what we should not do. Differential analysis is going to be looking at costs and also estimating revenues to make some decision-making estimates to see whether or not we are in the right direction and whether or not changes will be needed and what kind of changes we need to make. Generally, we're going to talk about decisions within the short-term period. Alternatives. Differentials is really evaluating two different alternatives, alternative A or alternative B, and what are the differentials, what makes each one of these alternatives viable and which one is the best for you. So, definitions. We are going to make certain it's clear that we're not going to be dealing with sunk costs, and they are going to be costs that we can't change. And again, although for financial statement purposes, sunk costs are relevant for our purpose, we're going to be ignoring those. We want to make certain that we have costs that are not sunk costs, because they're not necessarily relevant for decision making. So, and let's figure out what they are. What are sunk costs? And sunk costs are going to be costs that have already been incurred. That's really, really the most basic definition that I would take from this chapter. So, differential costs versus total costs. Again, management is going to show detailed costs about what decisions that need to be made and alternatives. Where we are right now is going to be the status quo. Then we have our alternative, and then what's the difference? And again, a lot of our changes and a lot of our decision making sometimes will revolve around different financial numbers, but there are also considerations that are non-financial. Just so you know, it's not always financial reasons why a decision is chosen over another alternative. There are also other factors. So how do we use that? What we want to take a look at is how our costs look, what they look like, and then an activity. Again, as you know, variable costs always have to be covered, and variable costs are going to be going up in proportion to the production. So you're going to see that relationship between the two. But as you know, fixed costs have to be covered in the long run. So we always have to consider both of those in our pricing decisions. So again, long run, we're going to talk about things that are going to be all longer than a year. Short run, 1 year or less. That's basically what we're thinking about. So pricing decisions in the short term, pricing decision, and the long term decision process. And again, what we're trying to get you to see in this chapter really is just to talk about how we are using financial information and how we're compiling that information to determine whether we stay where we are, which is going to be the status quo, or whether or not we choose from various alternatives using some information that we've gathered and financial information that we've gathered. And again, we're talking about desert adventures. We see the one-time offer for 5 additional tours at a discounted price of $700 per tour. The question that becomes, should we do it? Should we not? And what this particular scenario wants you to see is we're trying to decide on whether to do it or not and have a mathematical reason for accepting or rejecting that offer. So with that being said, the regular price is $900 per tour. See, there's a $200 difference. So if we have idle capacity to take the offer, let's put some numbers down. If that tour costs us $900, or we're going to charge $900 and 20 tours, we got to get our variable costs and get our contribution margin. Here we have fixed costs as well. So with the status quo, it's $6,600 in operating profit. Now, if we analyze it using our status quo, which is what we talked about, the $6,600 in operating profit, what would be the difference if we accept the special order? First of all, we get $21,500 in sales revenues. Our variable costs will go up a little bit. Our contribution margin obviously looks different. But then we look at the bottom, we see our fixed costs remain the same. So if we accept the offer, we have a operating profit of $8,600. If we reject the offer and stay where we are, we have an operating profit of $6,600. So the differential then becomes $2,000. Should we accept? Should we not? Again, that's what this chapter is all about. Should we stay where we are? And if we do, why would we stay where we are? Analyzing the numbers, seeing what those differences are, a different decision could be made, because now you have enough data to say this is not a right choice, or this is a right choice. We should do this. So understand several approaches for establishing prices on cost for long-term pricing decisions. Again, we want to make certain that our differential costs are very low on the short term. But in the long term, differential costs can be higher, and it might be acceptable because in the long run, we might very well make out better. And you can use those type of analysis to see estimates, of course, whether or not that's a true statement or can possibly be a true statement. So in the long run, organizations have to cover all their variable and fixed costs, both manufacturing and selling. We know this, but we want to be certain that in the long run, we end up on top, meaning we can cover all of these costs. Because in the long run, it might be a bad idea, but in the short run, it might be a good idea. And that's, again, a management choice they have to make. They have to think about it. How are we looking at this particular decision? Is we going to look at it in the short term? In the short term, it might be good. But in the long term, if we take the same decision and we use it for a long-term decision, a pricing decision, it might not be to our advantage. So product life cycle is concerned with covering costs in all categories of the life cycle. And again, we're talking about how do we affect price? How do we determine price? And using that information to determine production or the variable costs in those production lines. How can we reduce costs? How can we control our variable costs in order for us to increase our contribution margin and ultimately our operating profit? So target costing from target pricing. This is target price based on customers' perceived value. What would the customer pay? How much profit do I need? Can I make it at this cost? Very key questions, and requires differential analysis, among other tools that you can use to answer these questions and make a reasonably intelligent, financially prudent decision. So when I think about costs, obviously predatory pricing, dumping, and price discrimination, this is not necessarily things that all organizations have to deal with, but it's something that you have to consider. And it depending on what you're trying to sell and how you're trying to sell it and the way you're trying to sell it, and also being very careful of the legal issues that relate to cost and sales price. Again, these terms here, I think you should be aware of them and see if there's some experience in your background that you've actually witnessed a peak low pricing or price fixing and how it was handled. So how do we use differential analysis for the production decision? Well, we want to determine if we should make it or buy it, decision to make goods or internally or outsource. Should we add a product line, or should we add a business unit? Should we decide on this product that offers or a combination of products? Those are the types of decisions that you'll have to make, and you'll be using financial information to make those decisions. So if we use an example, we want to take the tour example. Each tour costs a certain amount of money. If we have a certain amount of tours, then we can calculate reasonably close how much cost associated with the number of tours that we're going to have. And if you're going to expect to do 150 tours, what will be your expected operating cost, or your total operating cost per tour? And that's some very important information, because then you can say, if it cost me $1,400 to put together this tour, then I have to think about what kind of variable cost and fixed cost that I will have to cover, the total cost to cover, so that I can make a reasonable profit. I want my profit margin or my contribution margin to be X percentage. So that will be a very important number to make that determination. Make or buy decisions. Should we make it? Should we have someone else do it for us? And again, this analysis is very straightforward, but it's really actually a very good way of looking at things. Can we do well the way we are right now, which is the status quo, or should we take an alternative? And what would be the numerical side effect of that? Sorry about the light. Nevertheless, that's what you have to think about. What you think about is how do we consider these costs? What are the opportunity costs if we decide to do it? Can we quantify it? And how does it look side by side with where we are right now? Very important decisions. And as you can notice that in these in this analysis, none of the calculations are very difficult. They're very intuitive type of analysis. It's something that you would do. Think about your own decision. Should I buy a new car? Should I buy a used car? Two alternatives. And this particular decision is going to be a long-term decision. Should you buy it or should you not? Or should you buy a used car at this dealership or buy a used car at a rental dealership? Again, opportunity cost, comparing two alternatives, weighing what would be the best in the long term, and using financial numbers to make a determination whether I stay with my car that I have or buy a new car, stay with the car I have, or buy a used car. Again, thinking about those. Opportunity cost is again another thing. What do you give up to make this decision or to make this choice? So opportunity cost. Thinking about that, trying to quantify, if possible, what will be the opportunity cost if you make that shift, if you make that change. So, again, when you're looking at all of these in your chapter, you're going to be seeing, here we are right now, and here's the alternative, and then mathematically, what's the difference? Now, what I find about this chapter to be extremely helpful is we're constantly, in everything that we're doing, making choices, doing this versus doing that, staying where we are versus making a change. It's constant. So everything in this chapter really does have real relevance to you practically that you can use even in your own personal life, not only with your own financial decisions, but others that you are given the opportunity to advise. Do we stay? Do we change? If we stay, why? If we changed, why? If we decide for the short term, this is the best decision, and we find that the decision for the short term is not best for the long term, all of which are decisions about choices and making financially sound choices based on information that you currently have. Nothing is 100%. It's all estimates, but you have to think about that. You have to consider that. You have to consider the fact that we're making a choice based on available information that we have right now. So how do we think about that? We think about what are the constraints? What are the things that will hold us back? What are the things that will be limited, if you will? Obviously, scarce resources is a very significant constraint, but also time is a constraint, capacity is a constraint. Again, identify what those constraints are. Understand what they mean and how it will affect the pricing decision or product choice decision. As you go through the chapters, you're going to find out that this chapter really does have a lot of good information and not too much of computational things that you have to deal with, because everything here really does depend on your understanding of accounting and understanding of how to compare one number with another number, and what the difference is, and how that difference will decide on whether or not you stay where you are or whether or not you choose to make a change for the long term or for the short term. Theory of constraints is a very big deal. It talks about how we focus on revenue and cost, and when we're dealing with a bottleneck, when things just come together and limits that process, it keeps you from going forward. How do we deal with that? How do we deal with bottlenecks? How do we deal with the constraints? How do we deal with the contribution of your organization, and how do we determine these variables and how they work together to either push you forward or limit you? The theory of constraints is a very, very important concept. And I think more than anything, what you'll find in this chapter is it's very much like, if I have a decision to make, this is where I am right now. This is where I would like to be, and what that difference is, and how that difference can either be beneficial or not. It gives you the tools that you need to make choices about whether you do or you don't, whether you decide on a project or not, whether you choose to go forward with a project or accept a special order or not. All of which we would like to see you make the most sound decisions financially and be able to support those decisions. Thank you very much for your time, and I hope to talk to you in the next chapter video.